Hello everyone, welcome back. In the first lecture, we talked about why should you invest in stock market. In the second lecture, we discussed about whether stock market is really risky or not. At the end, I gave you a quote. Stock market is risky as long as you drive yourself into risk. So before you investing in a company, you should do know the business of the company, you should know the management of the company, and you should do the fundamental analysis of the company. So as promised, here we are with the lecture series of fundamental analysis. So let us begin our lecture 3, how to choose a good company for better returns through fundamental analysis. Disclaimer. This video is for educational purpose only and not recommendation for any investment purpose. Before starting the section, let us discuss some of the financial terms. Because during the fundamental analysis, some financial terms are very common. So because we need financial terms to understand the market. So let us start with the first financial term, the financial year. So one financial year is considered from 1st April till 31st March. So what is the use of financial term? The use of financial year is the profit and loss statement of a company, the balance sheets, the financial statements, the quarterly reports, the annual reports, everything is released based upon the financial year. So as an investor, you should know that all the statements and all the reports are based upon the financial year. Now, as you can see, I have brought you to my Excel sheet and I'm having the fundamentals of the company. For example, let us take a company ABC, which is manufacturing chairs. So it is a chair manufacturing company, and there are initially 5 investors who are investing 20 crores each. So the amount which they are raised by investing is 100 crores. So this 100 crores is called as the equity of the company. The initial amount which is raised by the promoters, these initial investors are called the promoters. So the initial amount raised by the promoters is called as the equity of the company. Let this ABC company have an equity of 100 crores and it has taken a debt or the loan which you call of 100 crores. So the total amount or the total net worth of the company is 200 crores. So the initially when the company started, it had 200 crores in its hands. So after a year, it invested all these 200 crores and it has made a net sales of 120 crores. So what do you mean by net sales? The net sales is the amount which is earned by the company after selling all its goods, all its services, all its products. So the net sales is the earnings of the company in a year. Now, if you want to get in the profit, you have to subtract all the expenses of the company. Now, we'll subtract variable cost from the net sales. There are two types of expenses. One is the variable expense and another one is the constant expense. So variable expense varies with the number of goods produced. For example, the electricity, the raw materials, the laborers. If you are producing more number of goods, then you require more number of electricity. The same goes with raw materials and laborers. If you are producing less number of goods, you require less electricity, less raw materials and less laborers. Whereas the other one is the constant expense. That may be an advertisement. If you are producing less amount of goods or more amount of goods, the advertisement is constant. If you require a machine to produce the goods, if you produce more goods from that machine or less goods of the machine, you have to spend some amount of money on that machine. So these expenses are called as constant, and electricity, raw materials, laborers, etc. are called a variable expense. Now when you subtract the variable cost from the net sales, for example, this company had a variable cost of 40 crores. When you subtract the variable cost from the net sales, you will get the EBITDA. EBITDA is called as the operating profit. EBITDA is called the operating profit. EBITDA stands for earnings before interest, tax, depreciation and amortization. Earnings before interest. So you have taken 100 crore loan, so you are paying some amount of interest on that loan. Next, you as an company in India, you have to pay some amount of tax to the government. And depreciation and amortization, I'll be explaining you in detail in the further slides. So now when you subtract depreciation and amortization from the EBITDA or the operating profit, for example, this company has a depreciation and amortization of 20 crores. So when you subtract it from the EBITDA, you'll be remaining with the profit before tax and interest. Now let us subtract the interest. So the company has a rate of interest of 20%. So the company has taken a loan of 100 crores. Now the interest in this case is 20 crores. Now let us subtract the interest from the profit before tax and interest. When you subtract the interest from the profit before tax and interest, you will be remaining with the PBT. PBT stands for profit before tax. When you subtract the tax, let the tax be around 10 crores, and when you subtract the tax from the PBT, what remains is nothing but the profit. What remains is the profit, overall profit. So this profit is known as the PAT. Another name for PAT is bottom line. You should keep in your mind that these are some of the financial terms: the bottom line, the top line. So top line is nothing but the net sales, and bottom line is nothing but the PAT. Now we'll learn the depreciation and amortizing, the PAT margin and ROE in detail. Depreciation is the process of expensing the cost of the asset, tangible assets, over its useful life. So tangible assets is nothing but the physical assets, the assets which you can touch with your hands. That may be the machines, the computers, the desk. So all these assets can be touched with your hands. So when you're buying these machines, these computers, these desks, you should not put their expense in a single year's balance sheet. You should depreciate their value over its lifespan. So for example, this company ABC has bought a machine for 100 crores and its lifespan is 10 years. So in the initial balance sheet, it should not put this 100 crores as an expense. So year by year, it should depreciate the value. For example, in 10 years, the machine worth is 100 crores. So the lifespan of this machine is 10 years. So in your balance sheet, you should go on subtracting 10 crores as the depreciation of the machine. So this is known as depreciation. Now let us learn about amortization. Amortization is the deduction of the capital expenses in intangible assets over a specific period of time. Intangible assets are the assets which we cannot touch with our hands. It may be the advertisement. You are spending some amount of money as an initial investment for advertisement. The copyright you are buying, these all require spending of money. For example, this ABC company has given a contract for the advertising company for 100 crores for 10 years. So in this case, the amortization here is 10 crores. You should subtract 10 crores from your balance sheet each year as amortization. Net sales means the top line of the company and profit means the bottom line of the company. So these are the common terms we use while talking financially. Now we'll see what is PAT margin. PAT margin stands for profit after tax margin. So PAT margin can be easily found out by the formula profit divided by net sales into 100. Profit divided by net sales into 100 will give you the PAT margin. So what is the use of the PAT margin? So a company you are studying, you would like to invest in a company which is having a PAT margin fairly above the average of the sector. Now we learn what is return on equity, also known as the return on net worth. Return on equity, or the ROE, measures the profitability of a corporation. Corporation means the company. Measures the profitability of a company in relation to the stockholders' equity. In our ABC example, ABC company's example, the equity was 100. That is nothing but the shareholders' fund. So ROE can be easily found out by the formula net income divided by the shareholders fund. So shareholders fund is nothing but the equity and the net income is nothing but the PAT. So PAT divided by equity will give you return on equity or return on net worth. Now we are back on our Excel sheet and we are going to find the PAT margin ROE and ROE percentage for the above example. As you can see here, PAT margin can be easily found out by the formula PAT divided by the net sales into 100. So in this case, our PAT margin is 25%. And now we are going to find the return on equity. Return on equity is nothing but the PAT divided by the equity of the company, or also known as the shareholders fund. So in this case, the ROE is 0.3, and now we are going to find the return on equity. That is nothing but ROE into 100. So in this case, our return on equity is 30%. So return on equity is good. Return on equity is always considered in the percentage form. So in this case, it's 30%. So that is a good return on equity. The PAT margin is also good. So this company is performing really well. In the next session, we are going to take a live example of HUL company, that is a FMCG company, leading FMCG company in India, and we are going to see all these fundamentals in that company. Thank you one and all. Please like, share and subscribe our channel.